Welcome to The Explainer. Right now, there's a literal ticking clock in the financial world, and honestly, if you blink, you might just miss it. I want you to imagine a door slowly closing on a unique, completely risk-free opportunity, because that is exactly the scenario we're unpacking today. We're tracking a very specific financial opportunity that is basically on the verge of disappearing completely. The financial landscape is shifting incredibly fast right under our feet, so what's available to you right this very second? It might not be there shortly. We're going to map out exactly what's happening, why this timeline is suddenly so tight, and the mechanics driving this whole shifting environment.
Right now, we're talking about an annual percentage yield, or APY, of up to 4.40%. Let that sink in for a second. Finding a return like this usually requires stomaching at least some market volatility, right? Like you typically have to strap in and ride the roller coaster of the stock market to see those kinds of numbers. But today, this specific yield is available with absolutely zero risk. Now here's the catch. The stakes are incredibly high because this is absolutely not a permanent fixture. The window to lock in a 4% or higher zero-risk return might be completely gone in exactly 1 week. That is a fiercely tight timeline, requiring us to understand what exact forces are threatening to erase that 4.40% yield.
To really reinforce this urgency, the source material puts it perfectly. It says, there's a small window closing right now where you can still lock in a 4% return with zero risk. I really want you to focus heavily on those 3 words, closing right now. See, behind the scenes, banks have already been quietly lowering their rates. They don't exactly send you a loud, flashing notification when your earning potential drops, do they? No, they just tweak the numbers overnight, and suddenly, your hard-earned cash is earning less. Understanding exactly why these banks are quietly making these downward adjustments is your absolute key to navigating this closing window before it shuts for good.
Okay, let's dive into this to understand the exact tool we're actually using to capture this yield. It's the Certificate of Deposit, or CD. Now, if you aren't super familiar with the mechanics, just think of it like a financial time capsule. You agree to lock your money away for a set period, and in exchange for giving up access to that cash, the bank guarantees you a fixed interest rate for the entire duration. Basically, think of a CD as a shield. When interest rates in the broader economy start falling, this financial product acts as a protective barrier around your specific yield, ensuring that the 4.40% we just talked about doesn't get chipped away by economic headwinds.
The contrast here is incredibly sharp. On one side, you've got your standard regular savings account. But the critical flaw with this, especially in today's shifting economy, is that the rate is variable. It can literally drop on you at any time, often right in the middle of your savings journey. You might think you're earning a fantastic yield one day, and suddenly, well, you just aren't. On the other side, the Certificate of Deposit offers a fixed rate that is 100% guaranteed for the entire term. This sharp contrast really shows exactly why leaving cash in a regular savings account right now leaves your money completely vulnerable to drops, while a CD effectively freezes your rate in place.
And this protection builds beautifully across time, whether you choose to lock your money away for 1 year, 3 years, or a full 5 years. The real beauty of this mechanism is that your rate is permanently frozen for whichever specific term you choose. It literally does not matter what the broader economy does. It doesn't even matter what the Federal Reserve decides to do next year. If you lock in a 3-year term today, your rate remains completely untouched for those entire 3 years. That is exactly why timing matters so incredibly much right now. You actually have the power to freeze today's high rate before it disappears into the history books.
But why is this opportunity disappearing in the first place? Well, it all comes down to the Federal Reserve. They have already slashed interest rates 3 times back in 2025, and that action is the ultimate catalyst here. You see, when the Fed cuts rates, it sets off an immediate chain reaction across the entire banking sector. Banks respond directly to the Fed. Because the central bank made those 3 cuts in 2025, banks have been steadily and quietly lowering their CD and savings rates in response ever since. The downward momentum has already begun, and the pressure on these yields is very, very real.
And this brilliantly illustrates the exact twist in our timeline, July 28th and 29th. These are the precise dates of the Federal Reserve's next policy meeting, which is just days away. This right here is the absolute heart of the urgency we're discussing today. The market doesn't sit around waiting for you to make up your mind. On these dates, the Fed is going to convene, and if they decide to cut rates again, which frankly all the momentum suggests is highly likely, the landscape changes entirely. This meeting is the definitive deadline driving that closing window.
Let's walk through the exact chronological chain reaction that's about to occur. First, the Federal Reserve meets on July 28th and 29th. Then, if the Fed decides to cut rates, banks will almost instantly drop their CD offers in response.
It's a direct cause and effect. It's the exact same way they've behaved all year long. Once the Fed makes its move, the bank's response is practically inevitable. Honestly, by the time you notice your local bank has slashed its rates, it's going to be way too late to capture the high yields that are available to you right now.
To neutralize any speculation that this might just be a false alarm, the historical pattern is completely undeniable. Back in 2025, 3 Fed rate cuts directly resulted in banks lowering their CD and savings rates across the board. Moving into 2026, the pattern just continues. Every single Fed cut leads to another round of banks lowering their offers. This proves that we aren't just talking about some hypothetical, maybe someday warning. This is a consistent, documented reality that has been tracking steadily through 2026. The data is crystal clear. Every time the Fed acts, the bank offers shrink.
So, the crucial point is we need a balanced reality check here. Is a CD actually right for your money? Look, as much as we're stressing urgency, CDs are not right for every single dollar you have. Because your funds are locked up for the term, you will face an early withdrawal penalty if you suddenly need that cash. So please, whatever you do, don't lock up next month's rent money. However, this works remarkably well for money you know you won't need for a while. It's absolutely ideal for 1 to 3 year savings goals, and it's just a fantastic tool for an emergency fund you're actively building and want to shield from dropping rates.
Which brings us to the ultimate question you have to answer this week. Will you lock in your rate, or are you going to let it drop? If your cash is just sitting in a regular savings account earning close to nothing right now, knowing that rates are about to be squeezed even further, this is the week to act. Compare your options before they fall again. You've got the facts, you understand the timeline, and you know exactly when the Fed meets. Thank you so much for joining us for this explainer, and make sure you're subscribed to catch our next one on exactly how the financial landscape shifts after next week's meeting. See you then.